one, community matters because it does. Community is so important in Hawaii. Hawaii is a community, but it is also a collection of communities. And things that are important to one community are important to all communities, and we really need to get into the habit of the common good, of serving the common good for all the communities, because we're in this, really in this together in our isolated state, 2,300 miles away from any place else. Ooh, make you feel alone. That's John Kutsmeda. He's from Hawaii Mortgage Central.
Correct.
That's where all the mortgages happen. I can see all the people running around and all the
true.
computers and everything. What is Hawaii Mortgage Central, John?
We are a direct mortgage bank. So we
What
provide
is that?
So we provide residential financing as well as commercial financing, but directly as an actual financier. So you have depository lenders. We talked about this before, but
They don't remember.
okay, we're going to remind them. So you have depository lenders such as big banks that actually have the capacity to take in deposits and then lend against those, usually up to 8 times what they hold on deposit. And then you have other lending entities like my company, where we fund the loans with very specific criteria in mind, such as mortgage loans and real estate loans. And then those are either sold off to other investors to service and actually collect the payments on, and then become—
You act as a collection agent. You assign the paper to another bank, and then you act as their agent here in Hawaii to make sure that
Correct. So we're kind of on the front end. And the last time you and I spoke, the big conversation was about kind of adjusting the paradigm for people in terms of how mortgage loans are actually done. Going directly to the bank is kind of that old school mindset. Hey, it's my local bank. They know me. This is where I'm going to get the better interest rate.
We talked about that a little while ago. I mean, First Hawaiian Bank, everybody sees it as a local bank. You know, First Hawaiian, our Hawaiian is our middle name. Yeah. They're owned by the French in Paris.
This is true, yeah.
ENP, they're as local as, as somebody in Paris.
Well, even besides that ownership component, still the way the mortgage market, the engine, the way all of that kind of works, it's the same for how a big bank handles the loans versus a small, very focused niche mortgage bank like myself, where the loans are originated and then they're packaged and sold, securitized, and then they're serviced usually by much larger national entities. So the loans that I'm doing end up in the same hands as the loans that a Bank of Hawaii is doing.
I don't know why, but I have this vision of Scrooge McDuck. You're too young to know about Scrooge.
I know who Scrooge is, yeah.
Scrooge McDuck.
He used to dive in his vault.
That's right.
Yeah.
You remember. My God, you're older than you look. He had a swimming pool of money.
Yeah.
And he would dive in the swimming pool. So that's the way I envision you, John. Is somewhere around your house, maybe in your basement or in your backyard, you have a swimming pool full of money, and people come around and they want to have mortgages, and you just dig into the swimming pool and you give them the money. Isn't that what happens?
I think, your intro is all about community matters. I don't really think the guy hoarding gold in a vault somewhere. It's definitely about helping, the average person get a good loan.
Okay, well, what's interesting to me is that, if you went to a bank in this town, any bank, they would give, as a residential loan, I'd give you good terms, but you know what? On a business loan, they're going to give the tourism industry a loan much faster than you. And if they give you a loan, they're going to do an SBA guaranteed loan, and it's going to be a lot of paperwork, and it's not going to be the same thing as dealing with a lender who's more flexible like you. Am I right?
I think collateral is the big component, and we'll hopefully talk about this more, but anything that has a government guarantee right now is really where capital is flowing.
Do you get government guarantees on your business loans?
So we're an approved VA lender.
So you do VA guarantees,
yes.
Not SBA?
No, because we're not doing, our focus is real estate-backed mortgages. So the collateral there obviously is the brick and mortar.
So you don't do small business loans?
No.
Okay, show's over, that's it.
So much for community matters.
Cut.
Yeah. So, in terms of, the change of capital flows right now, and really the way banks are investing globally and even domestically, it really has to do with the safety net. So any kind of investment, especially in the mortgage loan pool environment, anything that has a government guarantee is going to be more attractive to the market.
Well, you don't want to take a risk you don't have to take.
Right. So therefore, those types of loans are much more attractive to the consumer. So your government-backed loans, like your FHA, VA, are...
Why is it more attractive to the consumer? Is the rate lower?
Correct, because there's more capital flowing into those types of loans. Therefore, the rates are lower.
Okay. Well, so I guess my question is, I'm just going on curiosity here, but we have been talking for months on this show about the homeless.
Yeah.
And we have found, for example, to our great surprise, that a lot of family homeless involve working people. Sometimes both spouses are working. They just can't afford to pay the rent, the cost of occupancy, and they can't afford to pay a mortgage because that, I don't know if that's more or less, but it's in the same vein. They can't afford to pay it. And they wind up sliding down the slope. Mm-hmm. They have their jobs. They never got fired or anything. They're minimum wage jobs. Sometimes they have more than one job per person, but they can't afford the cost of occupancy. And I guess my question is to you, I mean, I'm just waiting for you to get here. My question for you is, are you putting those guys out on the street?
No, I mean, in terms of...
Are you telling them that if they can't afford, you're going to foreclose them?
No, so my company as a whole is really more on the front end. So our motivation, our expectation is to make sure that clients aren't making bad financial decisions in terms of the assets that they're trying to acquire, the home they're trying to buy, and making sure that the loans that they're structuring are not only affordable in terms of what it is on a monthly basis, but they're not overpaying for an interest rate that they could get, at much lower cost.
There was a company in town, they were all over the country, I forget the name right now. I don't want to remember the name. I don't think they're in business anymore. They were really doing these really strange loans, mortgage loans to people who everyone knew could not afford to pay that mortgage. And they would take the property back. In a year or two, it would be a foreclosure. And they like to do non-judicial foreclosures, which is, the least favorite kind, the most draconian bad news kind that a mortgagor can have. And they took it back and then they sold again to someone else who was, who couldn't afford the mortgage. And it just went on and on and on. And each time there would be proceeds in the foreclosure sale, courtesy the next buyer who couldn't afford the property, and they would pocket that. It was a new way of doing business around mortgages. And I was involved in one or two of those. I thought that was really terrible what happened. Do we still have that around town?
No, and I think, that type of corruption and even just bad decision making.
Congress was all over these guys, ultimately put them out of business.
Well, and you're not, again, taking a big step back, understanding how the mortgage market works. All the capital, all interest rates kind of come from the same place. It's the mortgage bond market. And we're going to talk about the Fed later and interest rates, and it's really important that that foundation is in place, that the money that's funneling in to make mortgages happen, period, right? For the credit markets to exist, there has to be that outside capital flow going in, purchasing these mortgage bonds that are associated with these big mortgage pools. So, back in 2007 through 2009, really leading up to the peak, I don't care what range of dates you look at, basically what you're looking at is really unusual risk-taking across the board, from the consumer to the lender to the other side of that table, the investors that were funding that. So everybody got burned.
Some federal agencies went down, or quasi-federal, what were them? I can't remember their names now.
Fannie Mae and Freddie Mac
Freddie Mac.
were what we call government-sponsored entities or enterprises.
Yeah.
And they had this implicit guarantee that it was backed by the government, so it really wasn't, but lo and behold, it ended up being bailed out. But the point is that risk-taking was being made across the board, from the consumer to the market, and there was liquidations everywhere. And I think the credit markets in certain segments are much healthier now. But the point with all that is you don't have the investment going on in those types of mortgages and mortgage pools.
As they used to be before.
So you're not going to see those loans getting done because there's no capital on the back end that wants to, be part of that investment.
But one of the things that came out in all the congressional hearings, which you could see on C-SPAN at the time, was that we had this American dream. Sounds like Miss Saigon, the American dream. We have this American dream that everybody should have a house. That you couldn't exist, you couldn't lead a middle-class life without or a lower middle-class life without a house. And developers were building houses that, not here necessarily, but around the country, that sort of let people buy those houses. And people were buying those houses whether they could afford those houses or not. And then, of course, it all got shook out, and they lost those houses by the carload. They lost those houses in this period of the shakeout, right? In the late 2007, 8, 9, like that. But you know, it's not a correct assumption to think that everybody in the country should own a house.
Correct. I'm completely agreeing with you.
Some people just cannot afford it. I grew up in New York City, you know, apartment houses all over the place. Now, on Fifth Avenue, they started developing condos, and a lot of people have condos now. They can afford it. But in most neighborhoods in the city, honestly, most neighborhoods in the city, you get six-story apartment houses, and people rent them. And lots of them, I believe even today, are covered by something they named rent control during World War II. Rent control is where the rent could not exceed a certain amount, which we probably could use right here in River City. But what the point is, you could have a whole city, a whole generation, a whole community renting. You don't have to own your house. You have to have reasonable landlords. You have to have a lot of protection for tenants who are tenants of unreasonable landlords. But you can have a community without owning your house.
Well, part of the conversation I think we stumbled upon last time was the fact that although I'm in the business of providing credit, I'm kind of the antithesis of, you know, you usually don't ask a barber if you need a haircut. You know, ask a real estate agent if you buy. Yeah. You ask a mortgage guy, should I, you know.
What will the barber say?
I know.
Yeah. Oh, yeah.
Right. So, but I'm in complete agreement. I don't think people approach that decision appropriately. And I think that, you know, the American dream and all those types of things have perpetuated a lot of the problems. It's created an entitlement mindset. You know, it's something that the banks lobbied because, again, they want to establish as many loans on the books as they can. And again, credit creation is a big part of a growing economy, so it does help stimulate growth. But, you know, there's other things that type of investment in capital can go into. And really, at the end of the day, you reach the point where it's at now. And it was before in 2006, but here we are again, where it's completely unsustainable. And the things that have got us here are not sustainable. So the quantitative easing, all this money printing, a lot of the low interest rate scenarios, especially here in Hawaii, this notion, and I hope we talk about this, but this notion that foreign markets are going to be a big part of the stabilization in Hawaii. And
when you say foreign markets, you mean people from overseas investing in our real estate?
Correct. So you can go down the list from Canadian, Australian, Japanese, Chinese. That funnel of capital is going to slowly start to turn off, and has already started to do that. There's a big emerging market currency crisis happening right now. And so these little things, you started the show kind of talking about us being this little molecule of an island in this big globe of economies. But that big globe of economies is going to play a very significant role.
Yeah, well, okay, I mean, I'm really interested. When we come back from this break, which we're going to take in a minute, I would really like to talk about the effect of foreign investment in residential properties here in Hawaii. It's very complex. I'm sure you see that all the time.
Yeah, it is.
Very complex and troublesome. Now and going forward. Okay, we're going to take a short break, come back and really get into the meat of this with John Kutsmeda of Hawaii Mortgage Center here on Community Matters, because it does. Ultimately, we're going to talk about the Fed, mortgage rates, and the economy, and you'll really hear some stuff. We'll be right back.
Aloha, this is Alice Hagan from ThinkTech Hawaii Business Education Spotlight.
Thanks.
My show is a bi-weekly show on Thursday from 3 to 4 p.m. We invite interesting people, entrepreneurs, fascinating leaders who contribute to the social economic well-being of our state. Please tune in to my show, Business Education Spotlight, ThinkTech Hawaii, bi-weekly, Thursday, 3 to 4 p.m. Aloha.
Hi, I'm Chris Leatham, and I'd like to invite you to come and watch my show every Wednesday at 3. I'm interested in a variety of issues that have to do with politics and our local business economy. And I'd like to bring on guests who like to talk about everything from technology to social media to what we can be doing to improve our environment. And so I'd like to invite you every Wednesday at 3 to stay and watch my show here with ThinkTech Hawaii. And I'll see you there.
Okay, we're back. We're live. We're here with John Kutsmeda of Hawaii Mortgage Central.
Correct.
I misspoke earlier. And we're talking about community matters, talking about the Fed, mortgage rates, and the economy, and it's all connected. You were saying?
What was I saying?
Never mind. You were saying during the break, and we have the best things during the break.
This is true.
But we sort of divide our minds up between the break and the live segments. But let me ask you what I was getting at before we took the break, and that is, we have foreign investment.
Correct.
We have foreign investment in residential. It's like this is one of Hawaii's greatest products. You know, of course, this is what Hawaii is known for: condos around the world. You know, back in the 30s, it was Webley Edwards singing Hapa Haole music in the banyan tree courtyard of the Moana Hotel. That's what we were known for, and all the romance. Now we're known for condominiums, fancy condominiums all over the place, especially in Kaka'ako. They're beating a path to our door to spend way inflated prices. And my question to you is, how does this affect the market that you deal with?
The market I deal with in terms of mortgages, it's not, you know, we're kind of, mortgage rates, I would say, are more of a leading indicator of where things are going. But both the strength of the market and the volume of how many loans are being done, I think is kind of a real-time statistic. But mortgage rates in general have a big, a big play in that. What a lot of people don't realize is that mortgage rates are really more across, not just mortgage rates, but interest rates in general, are intended to be a signal of risk in the market. So the lower rates are the
less risk.
In theory.
So what are rates now here?
Well, on a 30-year fix, there's a lot of different ways you can structure a loan, but on
straight mortgage, conventional straight mortgage.
Still, you're talking, do you pay closing costs, do you pay points, do you do a no-cost loan, which is something we encourage quite a bit, but you're looking at a range of anywhere between 3.5% to 4% on a government loan, and anywhere from, I'd say, 4% to 4.5% on more of a conforming.
That's still really cheap.
It is. Now, the thing is what is going to happen in terms of the Federal Reserve. They've been talking about raising interest rates for forever, but it's been a hot topic this year.
Before we get to the Federal Reserve, I do want to cover that in detail. But these rates you just identified, that would apply to a local buyer or foreign investment buyer. Both the same?
Right. So without getting ahead of ourselves, talking about the foreign markets, a lot of the times the money that's being funneled into really anywhere in the U.S. because of the safe haven that U.S. really offers, from its currency to its bond markets to its real estate, a lot of that money is going into your primary markets, so your Manhattans, your Silicon Valley, your Bay Areas, even
residential prime markets.
Prime markets, your densely populated areas with, a AAA type real estate.
We can hold our own on prices.
Well, I mean, for better or worse, I guess that's a flag to wave. But the money is funneling.
I don't like to wave that flag.
Okay, well, me either.
People can't afford it, but
right. And when the money coming in isn't necessarily all speculative, but it's definitely there's a big component of it that's a hedge. So there's a lot of currency risk out there right now, especially in emerging markets like Japan and China and Brazil and Canada. Their currencies are getting crushed right now. A lot of people, smart money, that saw that potential coming.
Are you saying that guys from Japan, Brazil, Canada, whatever, would come here and take a mortgage at 4%, 4.5%? Is it worth it for them? Is that a return that they like to have? I mean, I can do better elsewhere, can't I?
I think the hedge is more about the currency swing. So if your dollar, say a year ago, Canadian, Australian, any number of them, especially those two, Canadian, Australian, was at par with the dollar. I mean, you're basically parity. If a dollar's a dollar, something close to that, and you make an investment here in Hawaii, let's say it's all cash. Let's take the debt component out of it. And then suddenly you have a big currency crisis, which you're having in Australia and Canada. I mean, it's like 70 cents on the dollar now. You've protected your.
So it's protection.
It's a hedge.
Not necessarily return on income, but protection.
No, and you're seeing this, I think it's playing out way more dramatically in other markets like Canada and Australia, where the Chinese, for example, there's huge capital flight.
They like protection.
And there's huge capital flight out of China right now into these markets, buying up real estate, and it's not about, is that value for my dollar? It's a simple, it's a place to park money.
So we should make the distinction between the guys who invest as mortgagees,
right,
and the guys who buy as buyers, maybe cash, who knows what. I mean, Chinese guys probably just do cash.
And that's kind of,
they don't even call you up, do they?
No, and that's kind of the argument, is that a lot of the money that's coming in and maybe speculating in these or bringing speculators in is simply, these are extremely liquid people, very, very wealthy, and they're really just parking cash. They're just parking the money as that currency trade starts to unwind.
They're looking for a capital appreciation too. I mean, if they come in as owners rather than lenders or investors. Well,
some of them are.
It's an investment. I mean, it's a capital investment, so they're owners, and they come in and they spend whatever, millions, couple of $1 million for one of those kaka'ako units. They expect to make a really interesting capital gain, don't they?
Maybe. I think that's kind of my argument here, is that maybe that's really not the play. Maybe what they're really doing is... Maybe
it's both.
I mean, if you can get both, it's win-win. I think the move is really trying to... it's a little more technical, but basically for the long haul here, you've had China pegging its currency against the dollar. So that's bode really well for China because they can export at a very competitive level. But now you're starting to have this, really it's a global recession. You're having a global contraction. China's economy is not moving along at the 7-8.
So I want to talk about that. So you said we were going to talk about mortgage rates and the Fed and the relationship with the economy. So when we have this conversation, are we talking first about the global economy and then the Fed making a decision of some kind, and then the return based on the Fed's change in the rate? Or is the sequence wrong? I suspect that the sequence may be these days that we're waiting on the global economy, then we act in response to that.
Well, I think people need to really take into consideration the full global picture, what we call the macro picture, because the Fed is. So you can't...
The Fed is doing that.
Absolutely. I think one of the things that has really put the Fed on hold for the longest time, and I feel like for years, they've been putting a lot of emphasis on the employment number. You know, the unemployment number, once it hits this level, you know, we're at liftoff, or we're at escape velocity, or any number of these terms that suggest that we're ready to, you know, kind of tighten monetary policy.
You do that when you have an economy that's going well.
Well, and that number just they keep moving it lower and lower and lower, and they keep saying terms like we're data dependent. You know, they're really just ducking and weaving and waiting for the right time.
But you're saying that they're making the interest rate lower and lower.
No, I'm saying the unemployment number.
Is going lower, and therefore the Fed is more interested in raising their rate.
Correct.
Because that's an indicator the economy is doing well.
So for them, for a while, they said 5.5%. Once we hit 5.5% unemployment, we'll be good to go. Now we're down below, I think, 5.3.
And they haven't done it.
No, and I think unemployment is a iffy number because the way they calculate it doesn't take into consideration the participation rate, which is at the longest.
What is the participation rate?
The actual number of people who are trying to get work.
Just another element of the unemployment figure. But I mean, could they be waiting for some kind of change on a global basis? Maybe they consider the global market a little volatile right now, and they think it might affect the American economy, and therefore they're holding back on making the assumption the economy is doing well until they see how the global thing stabilizes or not, right?
Absolutely. So a lot of what's been happening, especially the past 8 months, is really the past year and a half, is you've had the dollar rally extensively. So a stronger dollar means, in a lot of different ways, a potential weakening economy here because our exports become that much more expensive. So it affects GDP.
Sell less.
Correct. Yeah, it's great for imports, but at the end of the day, we still need to generate, income.
Why is the
around.
dollar stronger?
There's a lot of reasons for why potentially the dollar's stronger. I think one of the core components is safe haven. I think, and just
The same thing about parking money.
it is.
Whether it's in real estate or in banks, you just want to get it out of China.
So one of the things I was talking about before is how China pegs against the dollar. So you've had what's been called a carry trade, where with all this monetary easing that the Federal Reserve was doing, is really printing money, it was suppressing interest rates. People would borrow in dollars and then invest in RMB or yuan or the Chinese currency. And because China was pegging itself to the dollar, it was a relatively non-volatile investment, because no matter where the dollar went, Chinese currency.
The dollar was more stable than the yuan anyway.
But the yuan was pegged to it. So no matter where it went, your carry trade was fine. So if you invested in if you borrowed in dollars and then invested in the Chinese currency and invested at higher yields. So if you're borrowing at say 2% in the US and investing at 8% in China, you're getting that carry with very little currency risk. What really kind of blew that trade wide open really over the past 6 months is you've seen a huge correction in the stock market in China.
Okay.
You've seen that economy as a whole, China's economy, contracting. And because of the potential of the Fed raising rates, which is bullish for the dollar and is in many ways tightening of monetary
But the
policy.
Fed is held back because it wants to see what's going to happen in
But the
China.
market's already kind of run ahead of the Fed. So the
What is
dollar's
the market doing right now?
the dollar's strengthening significantly. So what's happening, the point of all that is if you've borrowed in a weaker dollar and then you're invested in, Chinese yuan, and all of a sudden, which China just did recently, which is they devalued your currency, your principal is getting wiped out. So now you have less money over here to pay back the money that you borrowed.
Bad investment.
Plus it's strengthening.
Bad.
Right.
Worse.
So what happens is you have what's called a capital flight. So now people are unwinding that trade and pulling dollars
Back in the U.S.
which is only strengthening that
The
dollar
dollar.
trade. Yeah, so it's this self-fulfilling feedback
Yeah.
loop. And
Okay,
this
let's talk about China. So much of this is driven by China.
Yeah.
I mean, our whole show really is driven by China.
Right.
The Fed's watching China. Everybody's watching China.
Yeah.
And China's having some remarkable changes. So the first question on China, I hope we have time for this.
This might be a 2-hour show.
2-hour show.
Yeah.
Okay.
Yeah.
Be patient. Have
Yeah.
a beer.
Yeah.
So what's going on in China? Is the economy overheating? Is it bad leadership? Is it a lack of confidence in what's his name, Xi Jinping? What's going on that everybody is bailing out of China?
Well, I think China has benefited greatly from, again, easy money, the monetary policy of the U.S. and growth in general across all developed markets from the U.S. to Europe has really been what's fed the Chinese economy. They're an export nation. Now,
But they're trying to develop a consumer.
they are. And
Consumer economy. I mean,
absolutely, yeah. But that doesn't happen overnight.
Hu Jintao, that was his legacy. Why don't you guys do a consumer nation? But I don't think he finished the job.
They're going to, I think, transition to that, but not until you have this. Again, all these things are connected. So if you're going to transition to a more consumer-based, less export, that means you're going to be importing less, which is what's killing Canada, Australia, Brazil. Because
They like to export, yeah.
and a lot of these raw materials, so iron ore, coal, all those types of things that China has been consuming at a massive rate. So now that all that's contracting, China is shifting in addition to having its own economic contraction while it's doing this shift to a consumer-based economy. So you're
Is it
pulling,
really serious? Because, I mean, they're still fighting with all their neighbors. They're doing all these bizarre strategic things in, the islands around Japan. They're still playing. They're still playing the game. I don't see any contrition here. I don't see any, tail between the legs here. It doesn't seem to bother them one bit.
well, they just did this huge military parade too, which was
Yeah.
kind of like a beating of their chest.
Yeah,
But
exactly.
there's so many factors that come into play here. I mean, one of the things too you got to look at is what's happening in oil prices. I mean, all of this is deflationary. I think that's the main two components to look at before we get into the Fed and interest rates here in the U.S. is deflation And really,
What's deflation? Tell them what deflation is.
so deflation, I mean, there's a lot of different ways that you can kind of look at it, but it's really a huge contraction in demand. So it's the falling of prices is a simpler way of putting it. It's kind of been treated as the boogeyman by the Federal Reserve. They always have this 2% target inflation, but I don't know why.
It's the opposite of that.
It should be we should welcome deflation in certain cases because it's cheaper to buy things, but so much of what we do is based on leverage, high credit, and we want these
moving ahead.
We want
We
want these asset prices to inflate because it makes us feel like we're our balance sheets are improving.
Nice, gentle inflation, good for the economy.
That's the theory. I mean, that's
we're not having a deflation now, though. Not in this country. Maybe they are. China.
Well, that's the irony. Is China's basically exporting deflation. So stronger dollar is deflation because if your dollar is going to be has the capacity because it's stronger to be buying assets, raw materials, whatever imports at a cheaper price, that's deflation. So for example, you look at commodities. Commodities are getting hammered. Oil is in the 43, 45.
Oil is down, isn't it? Because people around the world, especially oil producers, sensitive to world economy, they're thinking that, the economy is settling down. So we won't need as much oil. We have more oil than demand for oil, and therefore the market settles down on oil. You're saying the other way around.
Yeah, actually I would disagree with that. I think the supply has been a big argument for why prices have gone where they've gone. The excess supply is really a big factor, but it's a deflationary wave. You have a stronger dollar. Oil is priced in dollars. The dollar is a reserve currency. So you're really, if you're looking at oil has basically been cut in half in terms of price. In terms of these big oil nations, OPEC and whatnot, you basically ripped anywhere from $3 to $5 trillion poof out of the market when that oil price fell. So that.
What do you mean, the global market?
Correct. So these are countries that they're still producing at a similar level of supply. The demand has contracted, but they're still producing. So basically, your supply is going up and up and up, which puts further downward pressure. But at the same time, the revenue that they're bringing in for the same amount of production that they normally do is basically being cut in half. So that again is bullish or strong for the dollar because now there's less dollars in the system.
Okay, so just sort of hold all those balls in the air.
Yeah, a lot of them.
Come back. Okay, we're going to ask John, is this going to lead to a global recession? And is the Fed thinking that? That's mind reading, but hey, why not? We'll be right back with John Kutsmeda of Hawaii Mortgage Central here in Community Matters. We're going to learn something about the future now.
And I am the host of Business in Hawaii. Business in Hawaii is a show where we invite guests to come on and explain the secrets of their success for having a successful business in Hawaii. Contrary to popular belief, having a successful business in Hawaii is possible, and there are many examples of that. So please tune in on Thursdays at 2 o'clock, and you can catch us live on livestream.com for our Business in Hawaii show. You can also get the archives on hawaiitechhawaii.com, and we're also on YouTube and also on Oleo and OC16 occasionally. So please join us, find out the secrets of success, how to have a successful business, and I hope to see you on Thursdays.
10 minutes.
Where do you learn this stuff? What books do you read? Put me in the right direction so I can, read books too.
I don't know. I think you're too busy for diving this deep.
Give me a book. Give me a subscription. Give me a website where I can learn about this.
I think start simple. Just follow the markets on a daily basis, like a Bloomberg.com or like a Reuters. I think you don't want to get too deep or too granular. You'll get lost in it. And those websites tend to kind of give you surface level viewpoints.
Okay, let's go to the larger question, then we'll come back to the U.S. I mean, it sounds to me, this process what did you call it, the trade, the carry trade?
Carry trade, yeah.
This is unprecedented at this level. And, what's his name? Thomas Friedman wrote a book 10 years ago called The Flat World, and for the argument that, it's all interdependent. And it certainly seems that it's become a lot more interdependent now, since then than it was then. He really found a fast-moving sea change on that. So here we are. Everybody is connected. Everybody is instant. Every market is watched by all other markets. This is great in this kind of like humanity coming together notion, but it's dangerous in the sense that if something goes wrong with this complex, global, ubiquitous connection, then we all suffer. So are we going to suffer, John Kutsmeda? Is the global market going down? You heard it here, whatever he says on ThinkTech.
I think there's some very serious risks out there, and I think minimizing how much debt you're carrying is an important, I think, first step. Consolidation, being liquid, but before we miss out on covering it, because we got so deep and granular, which I'm stoked about it. I wish we could keep going. I think the big topic is with the Federal Reserve Open Market Committee meeting on Wednesday and Thursday. Are they going to raise?
This week.
That's 2 days, yeah.
16th to the 17th.
So are they going to raise interest rates? And this has really been a debate. So they have these meetings bi-monthly. The Fed can raise rates anytime they want. That's in their, I guess you could say their authority to do so. But
how come when Greenspan was the Fed, it was on the news for weeks in advance and for weeks afterward. Now Janet Yellen,
Well, this is probably
this is big.
This is probably the most forecasted rate hike ever. And whether they're going to do it or not is highly debatable.
Well, what are the implications if they do it or don't?
Yeah, so I think it's irrelevant whether they do or they don't.
Really?
I think everybody's waving this flag of interest rates are going to go higher. I think that's really been the calling card of a lot of people, especially in mortgage and real estate. I think we've not going to see interest rates really do anything but go down. Again, understanding why is that the Fed is talking about raising the Fed funds rate, which is an overnight lending rate. So it's short-term interest rates that are really starting to already kind of feel the burn from a potential rate increase. The Fed funds is not directly connected to mortgage rates or to the Treasury market, which is U.S. government debt.
They could move it up. It wouldn't. Well, maybe
they can move it to 6%. Let's forget the fact of the hell that would release.
Okay.
But they could, and you could still have interest rates on
low.
On mortgage
your
rates.
mortgages that you'd be marketing would still
potentially,
be
yeah. So understand.
Suppose they leave it the same.
Suppose they leave it the same. I think you're going to see. Obviously, it's an unchanged circumstance. So the market's going to be able to continue as it's been going, which has been relatively stable for bond markets. The other reason why that's probably going to end up leaning beneficial to mortgage rates and the mortgage bond market is because if they don't raise rates, they're basically saying that the economy is not strong enough.
Yeah.
Isn't
that true though?
It is. I think we're probably heading into a recession. Everyone likes to talk about cycles when the market's not in their favor and like, oh, everything's cyclical, it's going to come back. Well, here we've been on this 7-8 year run. We're due for the opposite cycle.
And that's consistent with my fatigue theory. I'll tell you what my fatigue theory is. Want to know?
Sure.
I might have told you this before, John. The market goes up until it gets tired of going up. Then it goes down. And it keeps going down until it gets tired of going down.
That's a good theory.
Then it goes up.
Yeah. And that, in essence, is a bit of what you do see in these cycles. So they're not, you don't just follow the cycle with dogma, but at the same time, it's if you believe in the cyclical nature of the market, we're due for a correction.
But now the cyclical nature of the market is wider. It's global.
Well, I think the global forces are high risk. I think they're strong for the dollar. I think in a high risk environment, especially on a grand national scale like we're seeing, especially in emerging markets, that's that's bullish for the bond market in the US. People are going to flee these other currencies, these other trades, these other stock markets for the US market as a safe haven, in particular the US bond market. And the bonds are what really drive mortgage rates. So if you have money flowing in, the cost of the bond's going to go up, and the interest rate is an inverse of that. So as the price on bonds go up, rates are going to go down. So if the Fed doesn't raise rates in September, maybe it'll be December. It's probably looking more like maybe in 2016. If they don't, it's a clear sign after we've had continued job growth, albeit that job growth has been part-time, not really the
But it sort of requires them to raise rates.
Yeah, for everything that they've been saying, if they don't, they're clearly saying that there's bigger concerns. So that's what we call a risk-off scenario where people aren't going to be making.
It's funny how they're bound by their own statements, even if it isn't true.
Well, if you want to do research, you go to these different websites or read books. The term is the Fed's basically backed themselves into a corner.
Yeah.
Now, if they do raise rates because they feel like they have to, because in order to save face and maintain credibility, or really just to get to the point where they start to normalize, for the reason I believe is so that they have something in their back pocket. So when recession does hit, they at least have some kind of policy tool that they can use to ease the market. If you're at zero, there's really nowhere to go. So the only thing to do next would be QE4, basically printing more money. So if the Fed does raise rates, that is kind of starting to take the punch bowl away of this, easy money, loose monetary policy, and that's probably going to hit the stock market and more riskier markets first. And the unwinding of those markets, again, would be beneficial for the safe haven investments, which is bonds, mortgage bonds.
Come in and buy cheap stocks. So is your prediction, we only have a minute left, is your prediction that the stock market will go down?
Yes.
And what is your prediction on mortgage rates? They will go up?
No, mortgage rates, I think, no matter what the Fed does, are going to maintain stability and actually, I think, go lower, if not potentially significantly
So
lower.
I should cash in my stocks and buy real property?
I'm not going to agree with that prediction. We need another hour to kind of cover that. But the core is, there's a lot of debate over what the Fed's going to do. And I think most importantly, understand the principles behind the Fed decision and what each of these decisions could potentially do to markets. And I really think you look at it that way. No matter what they do, it's probably going to be good for the bond market, thus good for interest rates.
Okay, what about the economy itself? We styled this the Fed, mortgage rates, and the economy. So what's going to happen in the economy itself? Because that will determine the next phase.
I think you watch in emerging markets first. I think you keep an eye on the dollar index, and I think you watch what happens in these foreign markets like China and Brazil, these heavy exporters of raw materials, and these manufacturing, exporting type countries like China. They will unravel first. The US will be the safe haven. That's going to really strengthen the dollar against these basket of currencies, which eventually is going to put pressure on the U.S. economy.
So I stay out of the foreign markets for now.
Unless you really know what you're doing, yeah. Unless you know how to bet against that carry trade, which if you know how to put on that position, there's a lot of money to be made there.
Short the foreign markets for now.
Yeah, in the simplest form, yeah.
Yeah, wow, interesting. Well, if you didn't know before, and I guess we've said it enough, all connected. The 21st century is all connected. And here's a good example of it being all connected. Foreign rates, US rates, stock market, Fed,
currencies,
mortgage rates, currency rates. Why don't you just build a little black box with a formula that'll tell us exactly what to do?
Even if you had that formula, the world is so heavily manipulated by central banks that even the smartest minds in the investing world have been getting it really wrong based on timing, because you can't predict what someone who has the levers and the knobs to print money is going to do next. No one saw China devaluing their currency coming, and then they did, and that's really started to unravel this carry trade. Something else to keep in mind, we don't have time to talk about, is now China either needs to keep devaluing their currency, or they need to start to liquidate their capital reserves to defend their currency. Otherwise, they go into really a potential hyperinflation scenario.
So they've made some mistakes here.
Yeah, and they're in a tough spot for sure. I think long term, China, India, all the BRICS, those emerging markets have a lot of potential, but yeah, the next couple years are going to be tough.
I hope they call you.
Who, China?
Yeah.
No, China doesn't need to call me. Yeah, I'm just going to keep a distance from them for now.
John Kutsmeda, it's Hawaii Mortgage Central here on Community Matters. And we've been talking about the Fed and mortgage rates and the economy, and wow, it's been interesting. Thank you so much.
Thank you for having me. I appreciate it.
Aloha. Okay, I'm going to go and jump off a bridge.